Hey there, thanks for watching. In this video, we're going to be talking about why people lose money in the market, how to avoid losing money in the market, and generally getting over your fear of investing by learning the ins and outs of the market and how you can avoid losing money. So if that's something you're interested in, then just keep watching. For some background on me, I'm currently making an average salary in a very high cost of living area. I've gotten rid of $17,000 in consumer loan debt. It took me about 2.5 years, and I'm currently on a mission to become financially independent while staying true to my financial and my personal principles. One of my main vehicles toward financial independence is going to be my investment portfolio and my investments in the market. Since I didn't grow up with a very strong background in financial education, I didn't learn about this at home, I certainly didn't study this in school, I'm also on a mission to educate myself and to learn absolutely everything I can about the market, investing, stocks, and stocks in general. One of my biggest fears is losing money. I've heard these horror stories about people who make bad investments and end up losing their life savings, and I don't want to be one of those people that loses money in the market. So as a way for me to get over my own personal fear and also to continue educating myself, I'm looking into the reasons why people lose money in the market and what I can do to avoid losing money in the market. Here are 5 reasons why people lose money in the market. Number 1, they don't understand the difference between trading and investing. Generally speaking, trading is buying to keep for less than 1 year, while investing is buying to hold for at least a year or more. One of the main reasons people lose money is because they don't really understand the difference between investing to hold for the long term versus trading, where you're buying something to be able to sell it for a quick profit. People lose money because they start trading without any real knowledge or long-term plan for the future. The stock market is essentially about the future, and a disciplined investment strategy will look at companies over the long term and choose stocks and investments that will increase in value, rather than the day trading approach, which is buying something that you'll hope you'll be able to sell in the short term for a profit. While it might be exciting to see those short-term profits, this type of strategy is not sustainable long term. So the summary here is to look to the future, be disciplined, do your research, and employ a long-term strategy. The second reason people lose money in the market is because they allow their emotions to rule their decision making. One surefire way to lose money in the stock market is to listen to the media and to buy according to news that you're hearing. People lose money in the market because they let fear and greed drive their investing. One of the worst financial mistakes is to follow the herd mentality. Following the crowd without having any knowledge or substance to back up your decisions will almost guarantee that you lose money. For example, in the late 1990s, venture capitalists and individual investors were pouring money into dot-com companies. VC firms were looking for a quick buck, and individual investors didn't want to miss out on this opportunity. As a result, this was driving the dot-com companies' values sky high. However, most of those companies lacked the basic financial stability needed to sustain themselves over the long term. As a result, those companies went bust. This is known as a dot-com crash of the late 1990s. So the summary here is not to buy into overvalued assets, to make a disciplined financial plan and to follow it no matter what. The third reason why people lose money in the stock market is because they don't understand the basic market cycles. Economic and business cycles expand and contract. Boom cycles are strengthened by a growing economy, low unemployment, and various other economic factors. But as prices rise, interest rates start to rise as well, leading to a decrease in overall gross domestic production, which leads to the stock market declining in value overall. This is a cycle, meaning this is predictable and repeatable. While it's hard to predict specific dates, we can almost certainly count on the economy and the stock market to grow in value and then to contract in value, and then to grow again in value, and then to contract in value. So while you can bet for sure on these economic cycles, it's generally not a good idea to bet on the exact dates of when these cycles will occur. Otherwise known as trying to time the market. If you don't want to lose money, don't try to time the market. But do remember that there are cycles of growth and contraction that you can count on. Global events also have a huge impact on market cycles. While we're still untangling and trying to decipher the full impact of our current situation on the market cycle, we can look to the past for very clear examples. For example, on the first day of trading after 9/11, the stock market fell 7.1%, and that was the biggest decline in recorded history. So if you sold immediately following that huge global event, you likely lost money. However, if you just held tight and rode out throughout the cycle, you would have seen a corresponding rebound to the very predictable decrease in the market. Less than a month after the attacks, the Dow Jones, S&P 500, and the NASDAQ had all returned to where they were prior to the attacks. So the lesson we learned here is not to panic, but to plan your investments with an eye toward the future, to be able to give yourself the time and patience to ride out any unexpected events. The fourth reason people often lose money in the stock market is because they're trying to pick individual stocks themselves. This is a tip I've heard from seasoned investors time and time again. You can try to buy individual stocks and you might have some success, but by and large, your best results are going to come from either an index fund or an ETF. So these are funds that buy small portions of many companies. So for example, an S&P index fund would buy small portions of 500 different companies that make up the S&P 500 and allow you to track the growth of the market over time. This is just generally the safest approach. And yes, you won't get rich quick at all, but you will be protected from any sudden or unexpected losses. So you won't end up losing money in the stock market. If you do want to try your hand choosing individual stocks, then by all means, go ahead and do that. But make sure that you're doing it with an amount of money that you can more or less afford to lose if your picks end up not being that great. So the reason people lose money in the stock market when they choose individual stocks is because their choices aren't that great. Reason number 5 why people lose money in the market is because their financial goals don't align with their investments. Many people turn to the market as a way to get rich quick or to look to make a quick buck. And while there are certainly stories of people who have done this successfully, it's a 1 in a million shot. It's like buying a lottery ticket. So I want to take a moment here to address current events, and in particular, the Reddit subforum Wall Street Bets. So whether you've heard the news or been involved in some of this news, we can learn a lot from what's going on here. So this subforum is filled with information from everyday retail investors. So on the plus side, these types of stories and these posts are bringing a lot of power to the retail investor, which can be a very positive influence. On the negative side, these forums showcase very high emotion and very wild extremes. So there's a lot of high emotion, a lot of hearsay and speculation, and there are so many stories of such vast, wild extremes. So you have the extreme success stories. I made enough to pay off my house in 1 month versus these huge stories of lost. I lost $1.5 million in 5 minutes. So these stories of very high extremes are potentially hugely dangerous because there's no context. There's no way to place individual claims in the context of the greater movement of the market as a whole. These forums should be used largely for entertainment purposes only. And they can be very entertaining. So in summary, a balanced, disciplined, long-term approach to investing will ensure that you don't lose money in the market. Rather, that your investments will continue to grow in value and ultimately will be able to support you and your financial goals. Thank you so much for watching. Let me know down in the comments if you have any questions or suggestions or what your approach to investing is. Have you lost any money in the market recently? I really hope not. So as always, I thank you so much for watching and I hope that you'll keep watching. Bye.